So you thought Florida real estate was still the sunny jackpot? Think again. Behind the beaches and palm trees are housing markets sinking under insurance premiums the size of a car payment. And these aren't just metaphors. Rates have climbed fast in recent years, with hikes in the tens of percent, turning ownership costs into a math problem most buyers can't solve. Like this video so the algorithm thinks I'm important. Some places look like dream getaways, until you notice just how much investor money has warped them. In some metros, nearly a third of homes are investor-owned, which makes entire neighborhoods way more fragile than they look on Zillow. Here's the thing. You're not just fighting prices. We'll break down how oversupply, brutal insurance costs, and incomes that don't keep up with prices are eroding Florida's hotspot markets. And to see how bad it can get, let's start with the middle ground city that turned into a buyer's nightmare. Number 10. Lakeland. Imagine 1 out of every 3 houses in town owned by investors, and they all try to dump their properties at the same time. That's not a housing market, that's a clearance rack. Lakeland, sitting neatly between Tampa and Orlando, once looked like the Goldilocks option. Not too big, not too small. Families liked the commute options, investors liked the rental cash flow, and for a few years it felt like everyone was winning. But here's the thing. When you build a market around speculation, the middle ground can melt out from under you. In just 2 years, for sale signs multiplied like weeds, with listings climbing nearly 60%. Suddenly that stable mid-sized town doesn't look so stable. Buyers walk through open houses, see 3 more on the same block, and realize they have the leverage. At the same time, mortgage rates parked close to 7% mean that affordable monthly payment now looks like a high-end car lease. Prices wobble, offers stall, and the glow of those pandemic boom years fades fast. Then the hidden monster in Florida real estate shows up: insurance. Premiums in Lakeland skyrocketed more than 40%, adding $4 to $5 grand a year to ownership costs. Think about it. That's like strapping the price of a used Honda Civic to your annual bills and calling it homeownership. You don't see that cost on Zillow, but your bank account feels every penny. With higher expenses and slower migration, demand fizzles. Investors, who once bragged about doubling rents or flipping houses in 90 days, now scramble to unload before values slip further. Panic listings, price cuts, and hesitation stack up, and the so-called middle of Florida becomes ground zero for overbuilding gone wrong. So if that rattled you, wait until you see what's happening on the coast. Number 9. St. Petersburg. Think you're snagging Gulf Coast charm? Try staring at 5,600 listings just waiting for a buyer. That's not seaside demand, that's a warehouse of unsold houses. Here's the thing. St. Petersburg built an image as the cool cousin of the Gulf Coast. Artsy murals, a lively downtown, beaches just minutes away. On paper, it checks every box. But then you try to buy, and affordability greets you like a brick wall. Median home prices slid from about $450,000. At first glance, that looks like relief. But don't celebrate yet, because the trade-offs pile higher than condo towers. Start with insurance costs. Premiums spiked 60 to 70% in just a few years. Waterfront owners now face $10,000 plus annual bills just to keep coverage. That's basically a second mortgage you didn't plan for. Even homes that aren't right on the sand feel the ripple. Higher rates across the board push carrying costs way past comfort levels. And while you juggle those expenses, the market feels stuck. Days on market stretch longer and longer. Sellers wait months. Buyers circle cautiously. But the price of ownership keeps them from making the leap. It creates this stalemate where no one's truly winning. Now consider local paychecks. Average household income still sits under $58,000, nowhere near what's needed to balance $3,000 plus monthly ownership when you fold in taxes, insurance, and mortgage. It's like shopping for steak dinners with fast food wages. The lifestyle looks great from the outside, but the math screams something else. So you get this bizarre paradox: gorgeous sunsets, booming art scene, but with invisible bills that eat away at any upside. Investors don't score cash flow, homeowners lose relief, and buyers walk after crunching the numbers. St. Pete ends up paradise priced like a trap. That was a city by the sea. Now let's look further south, where a pandemic boom is deflating hard. Number 8. Fort Myers. Picture lawns full of for sale signs, where Airbnbs once booked out months in advance. That's the new normal in Fort Myers, a city that rode the pandemic wave straight into a hangover. Back then, Fort Myers was the sweetheart of investors. Tourism surged. rental calendars filled without effort, and quick flips made neighborhoods feel like revolving doors. Buyers came in droves chasing short-term cash and long-term growth. It worked until it didn't. Now the shine's worn off. Inventory crossed 5,000 active listings and prices are falling at about 6% year over year. That may sound modest, but in a town built on hype, momentum matters more than percentage points. You walk a block today and the signal is clear: too many homes, not enough buyers. Then you hit insurance numbers that feel more like tuition bills. Premiums between $9,000 and $11,000 a year hammer owners whether or not they live on the water. For cash buyers, that's a steep extra line item. For mortgage seekers, it's the difference between approval and rejection. Either way, it strangles demand. The problem doesn't stop at the front door. Tourism leveled off as travel patterns shifted, which means rental income dipped. Investors counting on vacationers to shoulder expenses aren't getting the payoff anymore. When the math fails, properties slide back onto the for sale list, swelling supply even further. And when you have oversupply, price cuts follow like clockwork. Sellers shave off asking prices slash for slash against neighbors, just to offload before carrying costs sink them deeper. The aura of quick gain paradise is replaced by the stress of drawn-out negotiations. Here's the kicker. Fort Myers flipped. What felt like an investor's playground has turned into a buyer's maze with too many traps. Next, we'll head to a city that looks healthy on the surface, but hides values inflated more than 40%. Number 7. Port St. Lucie. What's worse than high prices? Prices that don't even match what people earn. That's the story in Port St. Lucie, where shiny suburban streets mask the fact that homes are running way ahead of reality. On the surface, it looks polished, planned neighborhoods, wide roads, and the kind of strip malls that try to signal middle-class comfort. But scratch past the curb appeal, and the numbers stop lining up. FAU's housing data shows homes here sitting about 41% above long-term value. Let that sink in, almost half again higher than they should be. Meanwhile, supply jumped another 35% year over year. When inventory rises at that pace, it usually means the demand engine isn't revving loud enough to keep up. And here, builders didn't hit the brakes. They're still rolling out new subdivisions like the buyers haven't gotten spooked. Here's the twist. Local incomes never actually caught the rocket fuel of those rising prices. Paychecks in this city never kept up with the costs, which means banks start tightening mortgages and fewer buyers can clear the approval finish line. It's not just about sticker shock, it's about qualifying it all. For a lot of households, the loan officer is the gate that slams shut. Then there's the ocean tax, better known as insurance. Waterfront owners are saddled with steep annual premiums that can run into the thousands, eating chunks of the budget before you even fix a roof or replace an AC. Add that to an overvalued house, and suddenly your dream home looks less like a suburban win and more like a financial squeeze toy. So the payoff is pretty clear. Buyers in Port St. Lucie risk walking straight into inflated pricing right before the correction hammer drops. But luxury buyers aren't immune either. One Gulf Coast city proves even million-dollar homes can lose their shine. Number 6. Sarasota. Imagine paying $1.2 million for a dream waterfront place, only to watch a nearly identical home 2 years later sit unsold at $975,000. That gap is more than a number, it's a dent in status as much as a dent in wealth. In Sarasota, luxury isn't shining the way it used to. Here's the thing. This city thrived for decades on its retiree draw and polished image. With a mix of beaches, arts, and golf, Sarasota built a kind of upscale credibility that made buyers line up without second guessing. For years, it felt like one of those rare markets where paying top dollar still made sense. But the tide shifted. Inventory doubled, cruising past 3,700 active listings. The impact is clear. Homes aren't vanishing in days. They sit. On average, they now linger more than 90 days before moving. That kind of wait drains confidence, because luxury depends on momentum. The longer $1 million listing stays around, the louder the whispers about whether it's really worth that much. Now stack rising insurance on top. Premiums from $8,000 to $10,000 a year chew through budgets even for buyers with zeros in their account. Add inflation, weaker stock portfolios, and the psychological hit of shrinking assets, and suddenly the buyer pool feels thinner than ever. The homes didn't get less pretty, but the audience that can afford to bite shrank. So demand shrivels at the top while owners stand firm on aspirational listing prices. The new reality is a waiting game. Sell lower than expected or wait months with no guarantee. Gone are the champagne-fueled bidding wars. It's more like stale open houses and that awkward moment when you realize status symbols can lose shine too. Sarasota proves even the rich aren't immune to Florida's correction. But high-end woes aren't the only trap. Overbuilding in Jacksonville is setting up a mess of its own. Number 5. Jacksonville. What happens when your city becomes overbuilt before the jobs catch up? You get Jacksonville right now, where sprawl sprinted ahead of the local economy and is now sitting heavy on the market. Developers stretched suburbs deeper, and investors snapped up blocks of homes like they were trading cards. On paper, it looked like growth, but in practice, it filled the shelves faster than people could buy. Active listings now hover around 4,000, and that number alone signals a cooling market. Fitch even flagged the city as about 26% overvalued. That means the math doesn't pencil out the way it should. For someone house hunting, it looks like sticker shock joined to a soft job base. And when values stand higher than the fundamentals say they should, corrections tend to be messy. Then there's the insurance problem. Flood-prone parts of Jacksonville saw premiums spike as much as 60%. That pressure isn't just on waterfront homes. Neighbors a few streets back feel the same drag because insurers don't love the risk profile of this city. So even when the house price looks approachable, the monthly add-on tilts it right back out of reach. Add in the investor factor. Roughly 1 out of every 5 homes is owned by landlords or investment companies. That's a lot of places, either sitting empty, aimed at rent, or waiting for someone desperate enough to pay too much. If tenants slow down or vacancies rise, those owners may have no choice but to sell at discounts, flooding the market even more. With job growth cooling and wages lagging, there isn't enough organic demand to soak up the excess. So the rebound feels softer and slower than boosters predicted. The payoff here is blunt. Jacksonville isn't coastal paradise. It reads more like a warning sign for unchecked sprawl. But wait, if you thought that was crowded, look at Tampa, where the supply surge is even faster. Number 4. Tampa. Picture your listing surrounded by thousands of competing signs across Tampa Bay. Every block feels like a real-life classified section. That's what happens when listings jump from under 3,000 to more than 4,500 in record time. An 80% leap in inventory means you're not selling a home. You're trying to stand out at a yard sale the size of a city. Tampa rode high on its tech and growth story, selling itself as the hot market with endless upside. The cranes, the condos, the subdivisions, it looked unstoppable. But here's the twist. Too much supply turns booming into backed up. With homes piling up, the mood flipped from scrambles and bidding wars to waiting games. Now drop a 6.8% mortgage rate into the equation. Payments once around $1,800 now land over $2,600. That's like going from a Toyota lease to a luxury SUV bill overnight. For buyers, affordability isn't just stretched, it's ripped. The sticker might say median price of $385,000, but the monthly math feels a lot worse. Sellers know it too. Some already take 5 to 10% losses to nudge buyers into action. That's desperation, not confidence. Add in 40% higher insurance since 2023, thanks to hurricane risk and tougher underwriting, and ownership starts to feel like paying premium rates for second-tier rewards. You keep spending, but what payoff do you actually get? As days on market swell past 40, buyers have breathing room. They tour, they stall, and they lowball, because they can. Meanwhile, sellers bite their lips while carrying costs pile up. That hot Tampa market, it now looks more like a hold zone. Investors sit still, buyers wait, and the myth of unstoppable momentum collapses under its own math. Tampa's pain is clear, but Ocala shows a collapse that's even more dramatic when you look at sheer percentages. Number 3. Ocala. Imagine supply tripling in just 2 years, the market drowning in inventory overnight. That's where Ocala finds itself, staring at nearly 3,000 active listings after sitting closer to 800 not long ago. The result? A flood of for sale signs that makes this so-called hidden gem look more like a clearance sale. Ocala once sold itself as the affordable Florida retreat. Families wanting space without coastal sticker shock moved in. Retirees praised the horse country charm, and remote workers saw a budget-friendly option. Builders leaned heavily into that story, betting demand would never stop. But here's the twist. Supply surged faster than buyers ever did. A 275% jump in inventory doesn't signal healthy growth. It signals a market that got way ahead of itself. Prices followed predictable math. Median homes that touched $310,000 not long ago now hover near $275,000. And even at that discount, listings still linger. Momentum matters, and Ocala's market lost its stride. For recent buyers, that means clinging to a house worth less than what they paid. For sellers today, it means waiting longer and negotiating harder. The job scene doesn't help. Manufacturing and agriculture anchor the area, sectors that don't throw out high wages or sudden population growth. Hiring slowed at the same time housing ballooned. So even locals who want to buy don't have the paycheck cushion to absorb these costs. Add in the kicker, insurance. Rates climbed steadily despite Ocala sitting inland. Those hikes drained budgets, leaving fewer buyers able to carry the full load of ownership. So what's the trade-off? An oversupply of homes, slowing job growth, rising insurance, and prices dropping faster than anyone predicted. Ocala shows what happens when developers overbuild without the income base or infrastructure to back it up. But oversupply isn't just rural. Cape Coral's flood risks pile on another level of financial stress. Number 2. Cape Coral. Ever buy a house and then get slammed with a $30,000 city utility hookup bill? Welcome to Cape Coral, where the sticker price is just the opener, and the hidden fees make your wallet ache. This city ballooned during the boom years, with new construction stretching across canals and cul-de-sacs as if demand would never end. Between 2021 and 2023, active listings more than doubled, climbing from about 1,800 to nearly 4,000. Builders kept going, and now the market is heavy with supply. The result, home prices slipping 5 to 7% year over year, a median sale price dipping around $375,000, and properties crowding the market for 70 days or more before anyone bites. That's not the sprint it used to be, it's a line at the DMV. But here's the twist. Flood insurance in Cape Coral isn't an add-on, it's a budget bomb. Premiums routinely range between $8,000 a year. That's double the cost of some new car leases. Even for inland buyers who think they'll dodge it, the risk profile of the city makes affordable coverage scarce. That extra bill combined with taxes and repairs turns a fair deal into a long-term drain. Layer in mortgage rates hovering near 7%. That one variable alone pushes monthly costs hundreds higher than in the boom years. A house that once felt within reach now feels slippery, especially for local incomes tied to construction or tourism. The very industry's getting pinched in the slowdown. So what happens? Buyers see the math, shake their heads, and walk away. Sellers, meanwhile, sit with carrying costs. Insurance, utilities, HOA fees climbing while their listing grows stale. Cape Coral illustrates how what looks like affordable inventory hides trapdoors under the floorboards. Speaking of traps, let's finish with Fort Lauderdale, where coastal glamour hides financial erosion. Number 1. Fort Lauderdale. Ever thought you'd save money on a home just steps from the beach? Think again. Fort Lauderdale once sold the dream of beachfront condos as a safe bet. Today the dream is thinner and the bills are fatter. Prices that touched $650,000 2 years ago now sit closer to $580,000. That's a loss on paper before you even move in. And the correction isn't gentle. It's paired with costs that strip away any sense of relief. Here's the thing. The real bite comes from insurance and HOA fees. Average policies leapt more than 50% since 2022, now topping $7,000 a year. That's not chump change. It's the cost of a family vacation burned on paperwork. Stack on HOA dues running $500 or more each month, and your affordable coastal condo starts carrying the expense profile of a luxury loft in a big city. It looks glamorous, but the spreadsheet says no. Then short-term rentals, once the golden ticket, started stalling out. Airbnb occupancy fell 12% in a single year. Competition is heavy, cleaning fees creep up, and guests just don't come like before. Investors who bought banking on tourist cash now face gaps in booking calendars. And without steady rent, mortgages and fees don't get covered. The retreat is obvious. About a third of condos owned by investors are now listed below purchase price. That's owners trying to exit before the math gets worse. So what's left? A cycle where sellers chop list prices little by little, buyers hesitate fearing bigger drops, and everyone counts rising costs month by month. Fear sets in faster than the tide rolls in. The payoff is sharp. Fort Lauderdale turned the buzzword Ocean View Premium into insurance premium shock. Wrap up. So what do all these cities tell us about Florida in 2025? So what does all this mean for you? It's a correction. Some cities are softening faster than others, so the smart move is to run a simple 4-point check before you buy. First, confirm the full annual insurance cost, not just an estimate. Second, compare median home prices to local incomes and see if the monthly burn loan plus taxes and insurance actually works. Third, check months of inventory and new construction closings so you know if supply is drowning demand. Fourth, scan investor ownership and vacancy trends. Too many rentals nearby can mean faster losses. Comment yes or nope if your city made the list. And subscribe, because someday you'll want to escape.